Good evening, everyone. How are you doing? Good to see you here, Mr. Glenn Wagstaff.
Good to see you.
You look awful warm.
Yeah, well, we're not all in sunny places.
Yeah, I've been running outside today. It's been nonstop. And thankfully it's still manageable. Yeah, I think it was maybe in the low 70s or maybe high 60s. I'm not sure. I didn't really stop long enough to really check. Well, glad we got a chance to bring a few people together here and learn a little bit more about end of year tax planning. So I definitely wanted to introduce, the gentleman who I was just speaking about, Mr. Glenn Wagstaff, who's a good friend. Actually, has been working on developing what has seemed to be the largest estate planning attorney firm across the country, and so we are really excited to learn a lot more about from an estate planning attorney's side, impact and kind of how I guess how life can be much better should they make good smart decisions, right? All right, Glenn. And for those that don't know, I mean, if y'all had not had an opportunity to take a look at kind of the background of the gentleman I'm speaking about, I mean, he is well known throughout the country, and as not only again being the founder of his firm, but more importantly, looking at some of his accolades. I mean, having over 30 Best Managing Attorney awards and 8 International Best U.S. Estate Planner awards. Um, I mean, you don't get those just by, just by happenstance or just by accident. It has been through a lot of education and a lot of experience and a lot of being a business owner himself. And so, with that, Glenn, I'm excited to partner with you in this evening, and I would love to go ahead and turn the floor over to you, my friend.
Awesome. Well, Al, thank you again for that introduction. Thank you for this opportunity to bring some people together. And we're doing a few of these sessions where we're talking about end of year tax planning, because a lot of times people wait until April 15th to think about their taxes. And the problem is that when you sit down with your tax preparer, after the year starts, there's only so many options they can do for you. In fact, most of the time, what they're doing is reacting to what you did last year. So you don't have a lot of options to be able to choose from, right? Whereas what we are going to talk about today is what we call proactive tax planning, putting things in place before the new year starts so that you have a different menu when you go to your tax preparer and they can help you more. So we're going to talk about some of the basics. We'll talk a little bit about income tax planning. We'll talk a little bit about capital gains tax planning. And then we'll talk a little bit about estate tax planning. And a lot of times, business owners and individuals forget that there are different tax schemes here in the United States, right? But ironically, we earn the money, they tax it. We spend the money, they tax it. We save the money, and as it grows, we liquidate it, they tax it. If we pass away and we have too much, then they tax it again, right? And so there's a lot of different types of taxes that you have to think about and plan around. And that's what we're going to spend just a few minutes talking about today. And again, we'll open it up for some question and answer. But as we go, if you have questions, feel free to put it into the question chat or to put it in the regular chat, and we'll try to address those as we go. So, I always like to start this with a story. And well, it wasn't last year. I guess it was 2 years ago. We got a call, and it was actually, I think, on this day, or maybe it was on the 20th, but it was like right towards the end of December. We got a call from a guy who had sold $1 billion company, billion with a B, right? And so he was the majority partner, had to have had at least 600, $700,000 or $700 million in his interest, right? And he sold the company in February, and he had sat down with a team from Merrill Lynch, and they had told him to just pay the tax, right? They didn't have any solutions for him. He was looking at, it was like $270 million in taxes. He lives in California, right? Capital gains taxes on the sale of a business. $270 million. It's easy for somebody else to say, just pay the tax, right? So he goes and meets with another tax team with Wells Fargo advisors. And they told him the same thing, that they didn't have any solutions. He needed to just pay the tax. So he meets with another team. I forget what the third company was. But it was pretty much the same answer. You just need to pay the tax. So that was in February when he sold the business. He calls us December 20th. And he called us because actually someone from Al's brokerage had just started in the insurance industry, and he was a pastor of a church. And so, this individual that was the business owner wanted to make a donation to the church. And the pastor says, hey, before you make that donation, there might be ways to maximize your giving a little bit more. Sit down with our tax team and they can, talk about some options. So we sit down with the guy, December 20th. We gather some information. We come back with 3 options that would have saved him over $100 million each in his taxes. What do you think the first question he asked was? Why didn't those other guys share this with me, right? I met with Merrill Lynch. I met with Wells Fargo advisors. I met with, this other group. They're all tax professionals. How come they couldn't advise me on this? And the answer has to be one of 3 things. They either didn't know enough, they didn't care enough, or they would have made more money by not giving him the solutions, right? One of those 3 things. So unfortunately, because it was right at the end of the year, there wasn't a lot that we could do. We ended up saving him a few $1,000,000, which is better than nothing, right? But that's the power of proactive tax planning. It's also the power of having a team that talks to each other, right? Not just your financial professional, but having what we call the triangle of trust. Your legal professional, your tax professional, your financial professional, all on the same page, all collaborating, all talking about what's best for you. And that's the approach that we have in the Empowered Network. So we're very happy to be able to collaborate with Al, with his brokerage, and be able to do a lot of good work. But, the fact of the matter is that most people don't get this type of planning. And most of the time, even when they sit down with a professional, they don't get the caliber of strategies that we can bring to the table because they don't have everybody on the same page. So the first thing that we're going to talk about is income tax planning. A lot of times people say, well, I already have a CPA. So why do I need to look at meeting with a tax attorney or doing proactive tax planning? Why do I need to meet with them twice during the year instead of just once? And the answer is, again, like we talked about earlier, when you do your income taxes, your tax preparer's job is to save you money this year based on what you did last year. They don't have a time machine. They can't go back in time and change what you did. They can only work with the options that they're given. So in other words, you show up to file your taxes and you have a menu that was predetermined based on your activity from the previous year. Your CPA, your tax accountant is going to then use that menu to try to save you the most taxes that they can, right? With all of their expertise and knowledge and experience. But what if you could determine the menu beforehand? What if you could decide that you have different options for them to utilize when you actually show up? That's what proactive tax planning does. So the first level of planning when we talk about income tax planning is what we call deduction planning. And deduction planning is, in essence, using all of the deduction opportunities available to you to be able to minimize your income so that you show the least amount that would be exposed to taxes. Most good CPAs, good accountants, they're going to do a great job at deduction planning. But one of the things that's interesting is if you are an employee, a W-2 employee, you only have a couple dozen deduction opportunities. If you are an entrepreneur or a business owner, you have hundreds of deduction opportunities. You see how the menu is a little bit different depending on what situation you're in? If you show up to your CPA and you say, hey, I got my W-2 from my employer, my wife has her W-2, we need to try to save money in taxes. And, If you're in California or New York or one of these high tax states, maybe you're paying 40%, maybe you're paying more than that, right? I mean, it can be close to 50, 52% at the top levels. And you're getting killed in taxes, but then you don't have really any options. So you talk to your CPA and they're like, well, you can maybe donate all your money, right? Um, but that partially of the box that you're sitting in because of your personal situation, right? Because you happen to be, it makes sense to have a side business. It makes sense to have an entrepreneurial venture for tax planning, because if you don't have that, you're so limited on what deductions you can even utilize that half the time you can't even really engage in meaningful planning. And so, that's the first thing. The second, deduction planning, there's a lot of deductions that are not the everyday deductions that every CPA or tax preparer knows about. And a lot of times we talk to people, and even sophisticated business people, by the way, that every year they change their tax person. So last year they went to H&R Block, but the year before they went to Liberty Tax. And the year before that they used the CPA because, maybe they had something special going on. But then the year before that, their brother-in-law did it, right? And every year they have a different option. So there's no consistency in the representation for their taxes anyway. Well, that's going to be very difficult for somebody to be able to, serve you in the best way possible. And what we end up finding is that most of the time when we sit down with people and we look at their table, because they're not using all of the deduction opportunities available to them. So let me just give you one example, right? There's something called the Augusta Rule. The Augusta Rule allows you to be able to rent your own personal residence or one of your properties from yourself for use in your business up to a certain number of days per year, right? And that's just an extra deduction that is almost never audited. And it's an easy way to be able to claim more deductions if you happen to have a property and you happen to have a business. That's one of the ways that you can maximize some of your deductions. Taxes, do you think take advantage of the Augusta Rule? I mean, you would think that probably all of them, right? But the reality is that less than 20%, like less than rules that are a little bit more obscure. It requires somebody that has the experience and understanding of how to use them, but then you can maximize those deductions. So that's the first level of planning. Find a good person that can assist you with, finding those deductions. If you don't have a good tax preparer to do it, then work with someone like, with like our team that can give you a report and say, okay, here's what you would use, and then take that report to your tax preparer and they can implement it, right? So that's the first level. Even when people have a good CPA, they usually don't get beyond the first level, because the second level is the process of changing the menu. So we call it entity formations or entity strategies, right? Where you actually structure entities for your business needs, for your personal, asset protection needs, whatever it is. But those entities are then going to receive the income and declare it in the most optimal ways. And so when we structure these, maybe nonprofits, we use different structures for different reasons. But when we structure these entities, we're going to engage in something called income shifting. And income shifting means that we're going to take your income, whatever's coming in, and we're going to optimize where it goes. And then it's going to give you the least tax percentage, right? the least tax level that you can be at, so that you minimize the amount of tax that you're paying. Yeah, exactly. A tax bracket. Thank you. Mm-hmm. And by utilizing multiple entities, and depending on your situation, it may be easier or maybe more complicated, you're going to be able to moderate your tax exposure. So entity formations is kind of the second level of tax planning. If you get to that level and you've structured things properly, you've now built in ways for you to moderate how much you're going to show in your income. So you can actually decide how much you're going to show at the end of the year instead of having to declare whatever your CPA says, right? So for example, when I go to my tax preparer or my CPA, I show up the first time and I say, here's all my numbers, here's, what's going on. What am I looking at? And they tell me more or less what my estimated tax would be. And then I say, okay, great. I'll come back next week. And I go back home and I reread the numbers and I go find more deduction opportunities because I can decide where I'm going to show the income. Does that make sense? You can only do that when you have the right structures in place to be able to shift the income one way or another. So then when I meet with my CPA again, then I say, what if we did this? What if we did this? What if we did this? How much is it going to show in taxes? And we try to come up with the very best solution. And then we say, okay, let's file. And unfortunately, that's not the process that most people end up getting, right? So that's the second level of tax planning, is the entity formations, income shifting. The third level of tax planning is creating what we call loss engines. And a loss engine is an opportunity for you to be able to flow money into so that you can use it for your lifestyle expenses or your expenses that you're already used to spending the money on, but creating the excuse for why it can now be deductible. So a lot of times we say, okay, well, I have my business. My business is, my business happens to be a law firm, right? But whatever your business is, you say, okay, well, that's the only things that I can deduct are what are related to that one. This is a real scenario. Last year we were looking at doing this. What if I bought a movie theater and I was building out, a chain of movie theaters, and I happen to enjoy movies a lot, right? So every time that I buy a movie, every time that I go to the movie theaters, every time that I go and have an experience with the family, now that's a deduction. Why? Because it's research and development, because it's, the opportunity for me to scope out my competitors, because it's, now there's an excuse. So a lot of tax planning has to do with the excuses that you've pre-built. You can't come up with the excuse after the fact, but if you have the excuse before, then you can deduct things that you normally couldn't. So I'll give you another example. We have a client of ours, and they have their own business, but they have a son who does go-kart racing. And for anybody who does go-kart racing or is not aware of it, go-kart racing can be very expensive. and there's a lot of equipment, and you have to maintain the cart, and there's entrance fees and all kinds of stuff, right? And so they're spending all of this on this hobby, but they don't have a way to deduct it, right? And then they have a daughter who's in college, and they had just gone through a divorce. So now they don't have as many exemptions that they're going to claim because, one of the kids is not going to end up on the return anymore, and the spouse is not going to end up on the return anymore. And their income increased a little bit because their business is doing well. All of a sudden, they're going to pay a lot in tax. And they said, what do I do? Well, we were able to set up a structure that would allow her to deduct the go-kart racing as part of her marketing expenses. Why? Because she now has a marketing campaign tied specifically to the go-karts, right? And how she was going to use it and how she was going to brand her company and everything else. Because we put those excuses in place, then the IRS doesn't question whether it's a legitimate expense for the business. Then we put her daughter on payroll. Her daughter does help with the business, but we could get her to help a little bit more, right? But she's going to college. So she's paying tuition and all these things for the daughter, but none of that is deductible anymore because of her age. But since we put her on payroll and the daughter's in a lower tax bracket, it makes more sense for her to declare the tax than for mom to declare the tax. Does that make sense? So some of these solutions can actually lower tax dramatically, but they have to be put in place beforehand. So let me give you another example as it relates to entity formations. Most business owners take the path of least resistance when they're starting their business. What do I mean by that? Well, most of the time, business owners don't really think about what their business structure is doing for them or whether they need to change their business structure, except when they first start their business. we recommend looking at your business structure every few years, right? And to make sure that it's protecting you properly and everything else. A lot of times businesses start as a sole proprietorship or as a partnership because it's the easiest way to get started in business. You don't even have to really register anything, right? But the first level of business that's registered that you actually get protection in is called an LLC, or limited liability company. In an LLC, you get to choose whether you're going to be taxed as a partnership. In other words, if everything's just going to flow through to you, or if you get taxed as a corporation. And in a corporation, you get to do something interesting, which is you get to actually pay yourself a salary, and then everything else above and beyond your salary is treated as dividends or taxes. Dividends pay less taxes. So one of the things that's interesting is, as a partnership or a sole proprietorship or an LLC taxed as a partnership, you're paying an additional amount of tax that's called FICA taxes or self-employment taxes. Those taxes are an additional 15% above and beyond your normal tax rate. But if you have an LLC and you have it taxed as a corporation, or if you have an S corporation and you pay yourself a salary, you only have to pay that FICA tax for your salary. Everything above and beyond it doesn't get exposed to the self-employment tax. So you get to avoid 15% off the bat, right? We had a client of ours that we sat down with, and they were actually a barber, right? A hairstylist. And they didn't have anybody working for them. It's just a, one-man shop. They make about $70,000 a year, right? And because they're empty nesters, they were paying too much in tax. So he said, well, how do I lower my tax rate? So we took a look, and the first thing that we said is, well, set up an LLC, because right now you're operating as a sole proprietorship. That means, first of all, you don't have any protection in your business, but second of all, you're being taxed on all of this self-employment income with self-employment taxes. When we structured the LLC, we had him declare, taxation as an S corporation. So he pays himself a salary. In his case, it was like $20,000, and he pays FICA taxes on that salary, and then he avoids the FICA taxes on the rest. Just by doing that, we saved him $7,000 in his annual taxes. That's significant, right? I mean, that could be the difference between having a retirement or not having a retirement. It could be the difference between sending kids to college or not, right? It could be the difference between, having money for emergencies or not. And so that's one of the things that, could really make a big difference, is avoiding the self-employment taxes. At some point, businesses get to, they can grow to the point where they have enough income that it might make sense to then transfer from an S corporation to a C corporation. And as a C corporation, there are special types of strategies that you can utilize that we call fringe benefit planning. Fringe benefit planning then allows you to minimize the tax that you're going to pay in your corporation, because the thing that everybody's afraid of is double taxation, right? I apologize in a spot that's a little bit noisy. So double taxation is the concept that you have to declare taxes at the corporate level, and then when you distribute out to your shareholders, right, to your owners, then they're going to declare taxes at a dividend level all over again, right? So you're paying taxes twice, and most people don't want to do that. Well, how do you get around it? You get around it through fringe benefit planning. So there was an article that came out about 2 years ago about Elon Musk. And the article basically was an interview where they asked him, hey, you average like a 15% tax rate. Most Americans end up paying 20, 30, 40% taxes. How are you paying so little in taxes? And his answer was, well, I have C corporations and I pay the tax at the corporate level, but then I don't have to bring it home because I don't need the money. So if I leave it in the company, then, I don't have to pay the tax until I pull it out. And then, of course, even when you pull it out, there's strategies that you can utilize, right? And so that's one of the secrets that the wealthy use, is that they leverage the right kind of entities for their situation. And a lot of these strategies can help you to be able to minimize your tax rates so that you end up paying a lot less. So that's the primer, right, on income tax planning. And if anybody, found some value in what we just talked about, we can do a tax assessment to see whether we can save you some money on your income taxes before you meet with your CPA. I know we're here at the end of the year, so we only really have a week to be able to, do an analysis or be able to come up with some options for you. But if you have income taxes or what we're about to talk about, capital gains taxes that are going to be significant for this year, let's set up a time to get together, right? Get with whoever invited you. We can have that conversation. So the second thing we want to talk about is capital gains taxes. If you acquire an asset, stocks or crypto or whatever, what you put into that asset is what's called your basis. Your basis doesn't get taxed when you sell the asset, but whatever you sell the asset for, if the value is above and beyond that basis, you have to pay tax on the gains. That's called capital gains tax. And capital gains tax is at a lower tax rate in general than your regular income taxes, but it can still be significant because we're talking generally about large numbers. I mean, a lot of times for capital gains taxes, people might only realize them like 2 or 3 times in their lifetime, but it's usually for significant amounts, right? And so you end up paying large amounts in taxes. And minimizing your capital gains taxes can allow you to leverage that money for longer, let it grow more for your future. And in the end, you're going to have a lot more benefit by avoiding those taxes up front. So there are strategies for that. We utilize 3 different kinds of strategies for capital gains taxes. The first kind is what we call tax minimization strategies. So I'll give you an example. We had a little old lady. She had a property that she had bought. Oh, I don't even know when it was. It was like probably in like the 40s or something, but it was a long time ago, right? And that property, she had purchased it for $70,000. Now it was worth 1.4 million. Northern California property values just, over the last 60 years, obviously they just skyrocket, right? And so she was going to have significant capital gains taxes, close to a 40% tax rate. So what we were able to do for her was set up a structure called the charitable remainder trust. And this avoided all of the capital gains tax up front and minimized the taxes that she would have in the future. But it also gave her an income stream for the rest of her life so that she could live off of the proceeds. Now, at the time that she passes away, whatever's in the trust is going to go to a charity of her choice. And she chose to set up a foundation for her family to run where those proceeds would go. But she also was able to set up in conjunction with it a life insurance policy to replace that value for the family. So instead of, having, paying the tax and having 60% of the value, the initial value, what we did was we actually tripled the value.
And FYI, one other thing, again, while we're waiting for Glenn to get back on, is Glenn and the Empowered Network, how we have come together over the past, couple of, actually the past year. I've known him already now for about 6 years, roughly. But he, along with our network of the Empowered Network, is a professional business network that is, online, and where predominantly people like financial advisors, insurance professionals, could be property insurance professionals, real estate agents, brokers, title companies, estate planning attorneys, personal injury attorneys, CPAs, accountant, bookkeepers. And some of y'all I know are here from the BNI world, and in that synergy, a lot of times we create power teams, and that's a really kind of what the Empower Network is a very, very specific power team professionals like what Glenn has been able to share with you guys so far. But very, very grateful for again for this evening and him being able to share some of his insight and some what we would call case studies, examples of what people have had to deal with by not properly planning, but also seeing kind of the fruits of when people have properly planned. All right. Well, I will say this, if we're unable to get him back, again, end of year tax planning is a very, very prominent part of things that I'm involved with. And that's why I thought it would be extremely beneficial to have Glenn give his take again on the end of year tax planning. But as he also mentioned, we will also be doing other types of webinars like this in the very near future. So more specific on estate planning. So what Greg was mentioning is that we'll be able to show you some of the other topics that we are able to provide educational webinars like this for. And perhaps those might be of interest to you, and then you can also jump on one of those webinars and continue to help you and your business reach the levels that you're trying to reach. Glenn, are you there with us?
I'm here. I apologize. My my device died. I didn't realize that my battery was low.
It happens to the best of us, my friend. No worries.
All right. Well, I think we left off or we were talking about some of the options related to capital gains planning, and we were giving the example of a charitable remainder trust.
That's correct.
So, what we actually did was we tripled the value for her because she's going to live off of the full proceeds during her lifetime. She's going to be able to leave the full value to charity of her choice. And then through life insurance, she was able to replace the value for her family. We actually tripled the asset, right? Which is amazing. So that's just one strategy, right? We also have deferral strategies that can delay when you pay the tax. And most people, are aware of like a 1031 exchange for real estate. There are other strategies like that that can defer the tax to a later point in time. And then we have what we call tax offset strategies, which are essentially deduction strategies, where we can create deductions that will then offset the amount of tax that you have to pay. And we can do those even after a sale has happened. So, that scenario where somebody had sold a business, we were using offset strategies to be able to minimize the tax that they would pay down the road, right? Even after the sale already happened. So those are some of the strategies that are available. And if you have a situation where you've sold property or an asset or crypto or a business, and you're going to have a lot of capital gains this year, we still have a few days that we might be able to implement something to help you to avoid some of those taxes. And then the last thing that I just want to share, we'll open it up for some question and answer, and I apologize that we've had some technical difficulties today. But the last thing I want to share is in relation to estate taxes. Right now, estate tax exemption limits are very high. They're $12.25 million per person, right? And so essentially, if your estate is not over $12 million, you don't even have to worry about estate taxes when you pass away. But if it is over that amount, you have $12.25 million per person. So if you're married, that's double, right? The estate taxes start at a 40% tax rate, which is significant. Right now, it's $12.25 million. Adjusted for inflation, it's close to $13 million. Next year, it goes down. The law's going to the law's going to sunset. And because it's sunsetting, it's going to go back down to $5 million per person. So if you have an estate that's in between 5 to 12 million, right now is a very important time to do some planning, because we can grandfather in under the current law and be able to retain that exemption amount if we do planning before the law changes. So you have, in essence, until 1 year from now to put these things in place before the laws go into sunset. And a lot of times people say, well, yeah, but Trump just won the election. What if he extends all those, taxes and everything? The reality is that there's not a lot of political capital, even in the Republican Party, to change that law, because the dead don't complain, right? So if you're taxing the dead, there's not a lot of complaints coming back. And so there's not a lot of political capital behind it, because they've had it very high for so long that now they're trying to reduce the deficit, right? And we have a lot of overspending and everything else, and they need to bring in revenues from somewhere, and estate taxes is one of those areas that's a very easy target. So we don't anticipate, because this is not a law change. This is simply going back to the way it used to be. So it's going to be 5 million starting next year. And if somebody's over that limit, there are ways to plan around it to avoid it. So we should have those conversations. So Al, I'm going to turn it back over to you. We'll open it up for a little bit of question and answer. We appreciate everybody who jumped on with us. Hopefully the information today was valuable, and if nothing else, you probably know somebody who would benefit from some of this information. And what we ask is, if you found any value in it, just connect those individuals or connect with the person that invited you, so that we can set up a complimentary consultation, right? No cost. We just want you to have the information you need to make educated decisions for your needs.
Okay. All right. Let's see, one question that just popped up. What are all the options for 1031 exchange examples?
Yeah, so everybody's familiar with the 1031 exchange. It's a like-kind exchange that allows you to defer the tax so that you realize it at a later point. The problem is that it has very specific guidelines. You have to follow those guidelines, otherwise you can't defer the tax. And sometimes people, decide that that's what they're going to do, and then they can't meet the requirements, and then they have to pay the tax anyway. And so a 1031 exchange requires that you reinvest in the same kind of asset. And a lot of times people want to get out of that kind of investment. That's why they sold it in the first place, right? So we have 1031 exchange alternatives. One of those is called the Delaware Statutory Trust. One of those is called a Deferred Escrow Trust. There are other strategies that we can utilize that would do the same thing. But in essence, all we're doing is we're postponing when the tax is going to be paid. It's going to be paid at some point. We're just postponing when it has to be paid, right?
Right. And I'll just throw in a little bit onto that, and that's where, again, the timing and the planning is so incredibly important. I have had conversations where people have several million in talking to some asset managers, some wealth managers, that they have clients that have several $1 million and are already coming up close to what we refer to as the required minimum distribution year, and they know that they're going to be hammered by those taxes. And so it's so incredibly important that they start early on. Not that you finally get to, like, I know you just mentioned about the 12.25 million, Glenn, that's going to be dropping to 5 million. It's not that, when you get to 12.25, you start planning, or you get to 5 million, you start planning. Is that if you have the expectations of your assets that are on a path that is going to be growing to that amount, providing everything works to your plan, then you definitely should be taking that in consideration.
That's exactly right. That's exactly right. And in fact, sometimes a lot of clients that we work with are building wealth for the next generation, right? So they're maximizing life insurance. They're doing maybe the Rockefeller method or something like that to be able to leave more to the next generation. I sat down with a family, and they have a fairly modest estate, right? They own a home, they have a rental property, they have a little bit of savings, but they had $10 million in life insurance coverage, right? And they're not married. Well, when it drops to 5 million, they're going to be over that 5 million because, that's 10 million in life insurance plus the properties, plus the savings, plus everything else, right? And so it doesn't take much to get over those limits sometimes.
Right. Yeah, and that's actually a good point. I was just going to throw out there as well is, it could be just like the first example that you threw out about the property, actual real estate property that has been in your family for a while, and then now it's coming into a divisioning process because the estate needed to be separated and all that. Well, again, if the property's been around for quite some time, I mean, somebody's going to be dealing with taxes quite a bit, and it's incredibly important to make sure that you are guided in the right manner of how to prepare for that or how to deal with that. I see one other um, question on there that's stating, so you can only defer taxes in exchange of purchasing another property. Is that right?
So in a 1031 exchange, that's correct. But the alternative strategies that we just talked about, the ones that we talked about earlier, they do not require reinvesting. So you don't have to go into another property. That's why we call them alternatives to the 1031, right? Because if the 1031 is not a good fit, we can still do it without you having to go into another property.
Right. Very good. Very good. I don't see any other questions that are coming up yet, but I'm going to kind of throw something else out there. Because when you're talking about, I guess, and I guess maybe I'll throw this just as something for the future, for us to talk about, Glenn, maybe in an upcoming webinar. But as business owners, they have um, uh, either a plan for leaving. They call it succession planning. Sometimes it may be staying in the family. Sometimes it may be going into maybe to profit sharing to their employees, or maybe valuing their business and selling it to somebody else. So again, even something like this end of year tax plan that we're talking about, if that is something that is considered in the future, and then so that there is going to be an expected additional amount of money that's going to be coming into their total portfolio at some point, so that also should be taken into considered. Wouldn't you agree?
That's right. Yeah. So there's a lot of nuances to planning. When we do planning, we're going to look at 6 areas, and we're going to want to make sure that we're addressing everything, right? So everything from incapacity planning to estate planning to business planning and business succession to asset protection planning, tax planning, and legacy planning. And we want to coordinate with your financial strategies and with your tax strategies. But a lot of times, we assume that one solution is going to solve all of our problems. And most of the time it requires multiple strategies together to be able to address all of the things that we need, right? But that's the advantage of sitting down with a team like this one, where you have your financial expert, and you have your legal expert, and you have your tax expert, and they're all on the same page.
Exactly. Very good. All right. Well, I don't see any additional questions that are coming up as of right now. So guys, Greg, if you are there, I know you mentioned that you had, again, perhaps something that you could share of the different types of webinars. I know Glenn just mentioned briefly about some of those topics, but maybe if there's something that you could share of some of the areas that we could start planning for in the future for 2025.
So Greg's gonna share a link to our YouTube channel. We will be doing a variety of these webinars, and we'll probably schedule maybe a business planning one next time where we can talk about business succession planning and some of those considerations. That would be great.
Right. I got a question on there. Glenn, where are you located at?
Yeah, so our firm does work all over the country, but we're headquartered in the state of Utah.
Okay. All right.
All right. Well, thanks everybody. Thanks for joining us, and get with whoever invited you so we can schedule a time to talk if there was something of interest, or if you know somebody who needs this sort of thing. Again, we have about a week to do these appointments in order to address things this year. And as always, we're here to serve. So we'll be here next year.
Awesome. Awesome. Well, Brittany, I got your statement in there. We'll definitely be in contact. And for all everybody else, including Brittany, everybody who attended, we definitely appreciate your attendance. Hope you are leaving with something of interest. And again, feel free to reach back to me, and if I'm the one who had invited you, to see how we can help you get things in order. All right. Have a great rest of your day and week, and Merry Christmas if we don't see each other before. Take care.